love, falling in love with higher growth. The dot-com boom in retrospect was like a mirage. Only a few investors had the capacity to identify that a lot of new companies coming up in the horizon were not really software companies. They didn't have any software programmers working for them.
But it was difficult to identify which was which and what was what. Many listed finance companies were also adding software or .com to their name, and every promoter who wanted to cash on this were looking for ways to raise the market capitalization by starting a software company. The Financial Express on 4th May 1999 had an interesting story to reveal. Kraft's Food, which was a FMCG company, started listing itself as wanted to start a software company. Kraft was not the only company attempting to change the name, there were many more, and the market was biting. In fact, Kraft stock was illiquid and its price were very volatile. Nobody knew what this company had done before it grabbed the headlines of having hired Nanda Joshi from Mastek. Joshi saw that the company in few months and immediately left for the other opportunity. The stock price for most software companies listed in the stock market were showing a very high growth rate. Those were the good times. In fact, many of the gully startups that were coming up in the nooks and crannies of Andheri in Mumbai or Bombay were flashed with orders. Almost every company wanted to build a website. Any small startup company that could get some programmers trained in HTML and Java had their order books full. These small IT firms dreamed of going listing. If Narayan Murthy can do it, then why can't we grow like Infosys and go in for listing? A 35 years old owner of a small software company from Andheri said. His company had gained expertise in putting up websites in record time. While building websites helped revenues, these entrepreneurs wanted to create a product for banking, insurance, and retail markets. They had already started to hire domain experts to help them create these products. But Mumbai was tied just the tip. If you look at the graph, it was from nseindia.com. In Feb 2000, the ITPE had touched a high of 420, making it the most expensive sector ever at that point of time. In the same website, nseindia.com, both the Nifty index and the IT index were based to 100 so that they could be easily compared. By March 2001, the IT index was back to March 99 levels. There were twice as many IT firms coming up from Bangalore and Hyderabad that had programmers and some clients, but most importantly, there was fire in the bellies. While Bangalore had Infosys and Wipro, Hyderabad had Satyam Computers and Visualsoft, a firm that attracted a lot of investors like Bharat Shah, because it was one of the few companies that were serious about investing in IT products. Fast moving computer geeks. The entire market was now driven by the software segments. From infrastructure to FMCG, everything was placed on the back burner. Old school brokers like Parag Parekh and Ashit Kotichia were unable to understand what this entire software boom was all about. While the PE multiple of the software industry was 303 times in March 2000, the FMCG business was traded at 13 times. Kotecha did not understand the software business. I hate computers. I had never thought that these dabbas had such an excellent future, he said. Interestingly, Kotecha was at the same hotel where Narayan Murthy had held his first IPO conference in 1993. Kotecha refused to attend the brokers' conference as he had developed an aversion to IT. But as IT stocks price grew, he saw his business dwindle. The next 7 years were a nightmare for him. Clients wanted their money back, but since he was a well respected person, they would wait outside the office building and request for their check. Most of the clients did not have the heart to confront Kotecha. One day, when Kotija went home perplexed by the market rally in IT stock, his wife asked him why he shouldn't invest in a promising company like Infosys. That really did it for him. He decided to take the IT industry more seriously. He called up his good friend Bharat Shah, who was reputed for his understanding in the IT industry. Then he went to Hyderabad and met up with VisualSoft, the software company, when the price was rupees 300. Shah was told to buy the stock of VisualSoft at rupees 30 just a year ago, but he did not buy it then. Shah told him that the price would be rupees 3000. The price did touch 3000 in the stock market in March 2000, but then later it had a free fall. Kotija met the IT managers and promoters to gauge that what had really or exactly happened, what they were exactly up to, and what he was not able to understand anything. To him, it seemed that all these guys were going buying computers, renting office, and their stock prices were soaring automatically. He did not see any physical products, so he did not understand what they were really selling. He started to think that anybody could get into software business as there were no entry barriers. The PE multiples of these stocks were soaring. However, there was no point of buying these stocks as they have already become very costly. The period between 1997 to 2000 turned out to be extremely bad for the Ask group. Kotija even contemplated getting out of the stock market and pursuing something else in life. He spent most of his time in Rajgiri chambers opposite to the old custom house. It was also where Bharat Shah worked for Apple MF. Things improved for the Ask group after 2002. As he had not taken any exposure to the software stock, Kotija was in a better position as compared to many other investors when the market crashed. The IT index was fell by 81% over the 2 years, that is from Feb 2000 to Feb 2002. During the same time, the broad benchmark Nifty 50 index was down by 34%. Kotija owned 10% of the stock of the Elecon Engineering, which was available for rupees 1. The profit of the company was higher than its market capitalization. The value of Elecon Engineering in terms of market capitalization was rupees 6 crores and its profit was 12 crores. Imagine buying a company whose value was lower than its net profit. The company was available at a PE multiple of 0.5, Kotija says. There were companies which were available for less than 1 PE multiple. The Jammu Kashmir Bank was available for 15% dividend yield and the book value was 10 paisa. Interest rates were falling. When the interest rates fall, government bonds, for that matter, or any other tradable debt securities show a rise in price because they get repriced at the same interest rate. Many of these banks saw investments in debt securities and other interest bearing securities go up in terms of price. The India story was like never before. Banks like Punjab National Bank, Canara Bank, Union Bank of India have seen a lot of restructuring and they were recapitalized and the government securities that were holding were repriced due to the falling interest rates. This led to a higher book value and corporates were paying off their debts. Kotija purchased Jammu Kashmir Bank and Punjab National Bank and multiplied his returns by 7 times in the next 2 years. Then he went into construction sector. He invested in Larsen and Toubro, L&T, when the order book for the company was around 1000 crores and multiplied his investment by 10 times in the following 3 years. In the year 2007, Kotija decided to get into real estate. He started a real estate company under the name Pashima Realty and spent his time looking into low-cost housing in Bangalore, as it was then called. Kotija was a great investor who never allowed the law of averages catch up with him. In fact, he got Bharat Shah into PMS so that he could himself learn from his successful fund manager. Kotija no longer dabbles in equities. He feels that the real estate is his calling. Parag Parekh and Ashit Kotija were keener on investing in companies that manufactured products that could be seen and touched. Cement, saving creams, or for that matter, engineering companies that delivered output manufactured in a plant. Such outputs were measurable, but the same was not true for software. Skeptical fund managers still had their issues with this sector. All those fund managers and brokers who ignored this sector went through practically bad phase from 1998 to 2000, as this sector was the talk for the whole world. But then these were the fund managers like Bharat Shah at Birla Mutual Fund who understood the potential of this business. He could see that India was managed and could build a unique selling proposition USP that very few countries could match. He realized that companies like Infosys and Wipro were only a drop in the big IT pond. He was betting on product companies called as VisualSoft, which he felt had the potential for beating even companies like Infosys when it came to software products. It was the time when SSKI, a leading brokerage house, became sharekhan.com for its retail customers. It was the need for the hour to bring e-broker become the norm. Some brokers started to take orders on email and called it e-commerce. Even forex consultants were converting themselves into .coms. The boom was irresistible for many, but there were hardly any individual investors who wanted to take it onto themselves to start a mutual fund business. Nikhil Kattu was one of the few people who dared to do this in the market dominated by institutions like ICICI and Aditya Birla Group and the UTI. Kattu had started Sun FNC Emerging Technologies Fund but insisted that it was not a .com fund. He said that he would invest in companies that were using IT to grow faster. Hindustan Unilever became the prime candidate to invest in because it was allocating significant funds in the IT sector. Kattu had met Gul Techchandani during an interview and was really impressed by his skill as an investor. Techchandani was tired of infrastructure leasing and finance service limited and wanted to be part of something more interesting. He felt that Sun FNC was just the ticket. The fund was an old school mutual fund house and believed in value investing. They wanted to buy stocks and that through full of its potential and were being ignored by the markets. But then Kattu and Techchandani were investing in software stocks or brick and mortar companies investing in technologies to grow faster using this power of internet. The Emerging Technologies Fund was launched when the market was at its peak. Eventually, when the market crashed, the NAV of this fund hit a low. It took time for Kattu to rebuild the NAV for his investors, at which point he sold his funds to Principal Group USA for 11% of the asset. The size of the fund amounted to be 1,500 crore rupees. The Principal Group at the US-based financial group, which was a joint venture of Punjab National Bank, called the Principal PNB Asset Management Company for its mutual fund business. Kattu later told me that it was becoming difficult to stay in his business because mutual funds were now dominating by groups of big brands. They were companies that could pay higher commission to their distributors and maintain their high asset under management AUM. There were no space for independent players like him. He realized that it couldn't be easy for him to compete with companies like ICICI or Aditya Birla Group. They were known across the country and did not have the marketing muscle to fight it out. India again is a country dominated by brands, and in the early 2000s was not a time for the niche investment companies. He eventually moved to a private equity business where there was no pressure of a daily NAV.